All right, time for another rant. Should make up a series for this, call it some sort of rant series, but I want to talk about adjusting position size. This is a good conversation I had just a moment ago with another trader. People having a hard time adjusting to this market. And the reason for it, I don't think is the direction. I don't think it's because the market's down. I think the market's because it's incredibly volatile. So this is the current day's range on the market, right? This purple line is the opening price. No, the opening price right there. So this is the opening price. This is where we are right now. It looks like nothing at all happened today. If you looked at this a normal day, you say, oh, it's a pretty uneventful day for the market. However, if you go from the low to the high, here, it's 2.15%, let's say. That's crazy. That's not what normally happens in the market. Generally, for people who've been trading the market, this S&P 500 will move maybe a percent a day is a pretty big move. This from low to high, we're already 2%. We're halfway through the day, not even. And, crazy things could occur. So what do you do? And how do you trade these? Well, the first big mistake I see a lot of traders doing is not adjusting stop losses for what's going on. And I've said this before, you trade smaller. But what do I actually mechanically mean by that? So one thing we do over at Stats at Trading is we are exploring day trading strategies. I'm always building new strategies for you guys. So we're doing some testing on some day trading strategies. They've been going well so far. I have the alert bot that's kind of alerting people in real time when they happen. So that's all well and good. But when it comes to the stop losses on these strategies and the stop losses on our swing trading strategies, I'm always looking at mathematically what the prior candle was, or using something like ATR, which is average true range, which we can get into here as well. So I just want to show. So this is average true range, and this is kind of a 1 period average true range. You can see that most of the time, right, the market in this area was moving about this is a 3 candle, right? Maybe 10 points. These are points, not percentage. So maybe 3 points or $10 a share. Now on this candle, we had a $40 range, and we've already had a $10 range today. And I talked about how the market hasn't really moved, right? And it's a $10 range as an average true range. So first thing is, if you're not adapting your strategy based off of something like this, then I think you're definitely doing it wrong, right? Where we are sitting mostly in cash from a trend following point of view, but from some of the swing trades, I'll talk about. Let me grab one. Palantir, for example. Right, we bought Palantir right here on this purple line. That's where it was alerted to the room. That's where it was sent out on Sunday or Saturday or Sunday night. That was all sent, right? Just a normal pullback strategy that we have. The stop's way down here, right? It's way down here at 40. And the reason for that is that it's based off of the average true range of the stock, which you can see really kind of spiked in through here. Normally, maybe $5 or so a day and then up, right? Go to 1 week, probably makes a little bit more sense there. And you can see, again, we have starting to spike again after this initial move. So that's kind of the first thing that I think. If you're not mathematically defining where your stop losses are going and you're just randomly doing it, that can get you a lot of trouble. I hear a lot of people say, oh, I'm going to risk, 10% of a stock's movement on any trade. Sometimes that'll be a great idea. Sometimes it'll be absolutely awful. Where in volatile markets like this, that's going to be a really bad stop loss. In dead markets, you're not going to be risking enough. So find a way that adapts to the stock. One way to do it is Bollinger Bands. One way to do it is ATR. Another way to do it is just to take the average width of a bar and kind of eyeball it and say, oh, well, last week the bar was, 20 points. So I'm going to do that as well. But you have to do that dynamic position sizing. And then an overarching kind of way to look at it is that you've really got two options. One is you get hyper fixated. You get really active where you're looking to buy and sell things from a very, very active, very, very short-term point of view, knowing that you can have extreme moves one way or another. So hopefully you're doing that a little bit smaller. The other thing is that you just sit out, right? So if what I talked about, adapting your trade size, adapting your trading for this high volatility period is daunting to you, that's fine. Cash is a position. You can go to cash, you can read a book, you can learn a new language, whatever it is. But those are the only two ways to see it. What I'm seeing a lot of is people getting stopped out on both sides, right? They're trying to short, and then the next day the market rips 5%, they're getting stopped out. They're trying to buy, the market tanks 5%, they're getting stopped out. and just not understanding that the environment has changed. So those are three ways to look at it, right? You can look at, the volatility of the market. You can say in a high VIX environment, I'm going to use X stop loss. In a low VIX environment, I'm going to use Y. You can look at it just by kind of what I mentioned here with ATR. You can look at it with Bollinger Bands. Tons of different ways you can look at it. But please, if you're going to trade this market, just understand that the volatility is, I showed up to 10x what it was just a couple months ago. So you have to adjust your position sizing and your stop loss accordingly. This will allow you to sleep at night. It will also allow you to not get whipped in and out, because I don't think it's so much the direction of the movement that's causing people, especially traders, so much grief. It is the volatility of the movement, the fact that they could be right on direction, but then they get stopped out in the meantime. And it's because they just haven't adapted quickly enough. So if you want to use systems like mine that adapt, go to statsedgetrading.com. You can give those a shot, right? We're mostly in cash right now, experimenting with some day trading, doing some pullback, swing trading. If you're trading on your own, again, pick an indicator, some mathematical way to determine your stop loss. Not only do I think it will save you in this environment, but it also means you can focus more on what you're seeing on the charts or in the news or however it is you trade, and less on judging that position side. So there's my position sizing rant for today. If you guys like this kind of video, again, let me know in the comments. I'm always just making it videos that you guys want to see. Thank you for tuning in, and until I talk to you next time, just trade safe out there.